Welcome to today's Explainer. We're heading out on a quest to find a mathematical edge in a highly inefficient market. As an investor on the hunt for alpha, you're always trying to find that one hidden inefficiency. But to actually prove it exists, well, you need some seriously rigorous math.
Absolutely. And today, we're decoding a truly groundbreaking 1986 paper by Ruth Bolton and Randall Shotman, originally published in Management Science. Now here's the kicker. They didn't look at the stock market. They looked at the horse track. But the statistical models they built to find positive returns, they provided totally timeless, fascinating blueprint for retail quants and traders, even right now in 2026.
Right, so here's the big question. How do you actually find a statistical edge when the house is taking a massive cut? In modern financial markets, we usually think of friction in terms of bid/ask spreads, exchange fees, and slippage. Like if your trading algorithm makes a tiny 0.1% profit per trade, but your exchange takes 0.2% in fees, well, your model is mathematically bankrupt.
Exactly. You can't just beat the market. You literally have to beat the friction. And in the pari-mutuel betting system that they analyzed in this paper, that friction is honestly downright terrifying.
18%. Yep, you heard that right. That is the massive hurdle bettors face. In a pari-mutuel system, payouts are totally dictated by public consensus. Everyone throws their money into a pool, the track immediately takes a massive 18% cut for themselves and for taxes, and only the remaining 82% is distributed to the actual winners.
Man, imagine trading a stock where your broker just swipes an 18% commission right off the top. Mathematically surviving that, let alone actually profiting from it, requires an incredibly precise model.
Investor. Section 1. Racing against the market.
Okay, let's dive into the math here. To beat this massive friction, you essentially have to prove the public is consistently misestimating true probabilities. It's very much like the efficient market hypothesis in stocks. The fundamental math for a risk-neutral bettor to actually achieve positive returns is brutally simple. If the public's consensus probabilities exactly match the true winning probabilities, you're going to lose that 18% track take every single time in the long run. Right, so to win, your disciplined statistical model has to find situations where the true probability of an asset winning is greater than the public's consensus probability, plus that 18% friction. Basically, you have to find the exact mispriced asset where the crowd is completely wrong.
Quant. Section 2. Modeling the edge. So, how do we actually find this edge? Well, ad hoc filter rules just aren't going to cut it here. We need something mathematically robust. Enter the multinomial Logit model. It's a stochastic utility model, and what makes it absolutely perfect for this use case is how it handles finite competitive choices. Right, because think about it. A race is a zero-sum event. Only one horse can win. If one horse's probability of winning goes up, the probabilities for all the other horses must mathematically go down, right? You hit the nail on the head. The multinomial Logit model perfectly accounts for this competitive nature. It assesses the worth or utility of each participant relative to the specific competitors in that exact event. It's just like ranking a finite set of competing assets in a stock portfolio.
Okay, so to feed this model, Bolton and Chapman gathered a dataset of 200 races. They looked at specific variables that honestly act exactly like fundamental stock factors: past performance, current form, conditions, and jockey skill.
Yep, and when the researchers standardized all that data, one past performance metric totally stood out. AVAS-Pratt, or the average speed rating, carried the heaviest weight by far in predicting the true probability of a win. It was absolutely the strongest signal cutting through all the noise.
Now, the truly fascinating part of this paper is the explosion process developed by Chapman and Stalin. Keep in mind, data collection back in 1986 was incredibly manual and super expensive. They only had 200 races to work with. So how do you get more statistical precision without gathering more data? You explode it! Exactly. By taking the rank-ordered finishing data, they mathematically decomposed it. Let's say horse A beat horse B and horse B beat horse C. You actually treat those as completely independent mini-races or choice sets. This brilliant move effectively turned 200 races into 600 independent choice sets, drastically tightening the standard errors of their parameter estimates. But, and this is absolutely crucial, they capped this explosion depth at 3, so just first, second, and third place. Why? Because horses finishing at the back of the pack aren't really trying as hard, and including them would just inject random noise into the model.
Investor. Section 3. The betting algorithms. So, it's one thing to have a model. It's a whole different ballgame to actually trade it. How do we convert these precise probability estimates into a real strategy?
Great question. The researchers tested two primary algorithms on their holdout sample. First up is Isaac's strategy. This is your pure expected value maximizer. It assumes the bettor has infinite wealth, and it places massive, obtrusive bets. Then we have Rosner strategy. This one is highly risk-averse and maximizes the expected log return. Does that sound familiar? It directly mirrors the famous Kelly criterion used by legendary quants together. It optimizes for long-term asset growth using smaller, unobtrusive differential bets based on the exact size of your perceived edge.
Wow, okay, looking at the results, Isaac's strategy resulted in a catastrophic negative 27.8% return. I mean, the model was mathematically sound, so what happened?
Well, by making obtrusive bets, the algorithm acted like a giant whale, moving the market. In a pari-mutuel system, placing massive bets actually shifts the consensus odds. So the strategy literally destroyed its own mathematical edge by moving the market against itself before the race even started. No way around it.
Now, by keeping bets small and scaling them proportionally according to those Kelly criterion principles, the unobtrusive Rosner strategy didn't alert the market at all. It performed a lot better. But we still have a glaring problem here.
Yeah, a negative 6.4% return. The model is still bleeding money to that massive 18% track take.
Quant, Section 4, Avoiding the Long Shots. This brings us to the million-dollar question. If the model is mathematically sound and we're sizing our bets correctly so we don't move the market, why in the world is the strategy still losing? And this reveals the hidden danger in almost all financial modeling. Mathematically optimal algorithms fail in the real world because of the completely unpredictable noise of extreme outliers. In this specific case, the long shots.
Right, because no statistical model is perfect, right? They all have estimation errors. Let's break down the math. Say your model is off by an absolute value of just 1%. If you misestimate a strong favorite that has a 20% true probability, a 1% error is only a 5% relative error. Not too bad. But if you misestimate a 4% long shot by that exact same 1%, that is a massive 25% relative error. A tiny absolute error in modeling a highly volatile, low-probability asset completely wrecks your expected return calculations. The model was betting on long shots thinking it had this huge edge, but it was actually just betting on pure statistical noise.
So what's incredibly exciting is how they fixed it. They applied a really simple rule, a P-minimum constraint. They flat out refused to bet on any horse with less than a 7% predicted win probability. By ruthlessly cutting out those highly volatile long shots, where the data was just too noisy, their estimation errors plummeted. No way! So the Rosner strategy suddenly broke through the massive 18% track take and actually achieved a positive 1.3% return across the races. They literally turned a losing algorithm into a winning one just by acknowledging the limits of their own data.
But we definitely need a word of caution here. You can't just go and filter everything out.
Exactly. The researchers found that if you set that minimum threshold too high, say greater than 12%, you actually eliminate 55% of your viable bets. This totally destroys your sample size. You need enough occurrences for your statistical edge to play out over time. It's a real delicate balancing act. If you filter out too much just to fit the perfect curve, you run right into the risks of overfitting and data snooping. And when that happens, variance takes over and your returns are pushed right back into the red.
Investor Section 5. Lessons for Retail Quants.
Let's explicitly connect the vocabulary of this paper to modern trading. In horse racing, you have the 18% track take. In the stock market, that translates directly to your bid/ask spreads, your commissions, and your slippage. In racing, you have public consensus odds dictating the payouts. In the stock market, that's the efficient market hypothesis, the idea that the crowd has already priced in all available information.
For sure, friction and crowd efficiency are universal adversaries, and the exact principles from this 1986 paper directly mirror how modern quants handle complex classification problems today, like credit scoring or designing multi-factor models in 2026.
So, what are our actionable takeaways for retail quants building models today? First, model the competition, not just the isolated asset. Whether you're using a multinomial Logit model or a modern machine learning classifier, always evaluate assets relative to their immediate peers. Second, size your bets proportionally to your edge, mirroring Rosner and the Kelly criterion. Third, keep your trades unobtrusive. Don't be the whale that moves the order book and destroys your own alpha. And finally, ruthlessly filter out highly volatile outliers to avoid data snooping and overfitting. This precise methodology heavily influenced legendary quants like Bill Benter, proving that discipline and avoiding noisy data, knowing exactly when not to trade, is actually your ultimate edge. I'll leave you with this final provocative thought.
The researchers proved that a disciplined algorithm, armed with the right statistical models and strict risk management, can mathematically beat an astronomical 18% structural disadvantage. If that's possible in the chaotic world of 1980s racing, what hidden edges could your models uncover in today's financial markets? Thanks for joining us for this explainer, and happy modeling!